Hello, welcome to this short video about landlords. There's been a lot of tax changes to being a buy-to-let landlord in the last few years. I'm not going to go into the specifics of some of those changes. I'm going to talk more broadly around what is actually available still to you, particularly if you are an existing landlord. New landlords will have certain differences to this, and I would suggest a call into the office to have a talk with either myself or Jamie, possibly more me, as this is more of the tax planning route that I tend to specialize in. Now, one thing I would say to you is, as a general rule, that which can be claimed has to be wholly and exclusively for the purposes of the property rental business. Relief for capital expenditure, whether on a cash or an accrual basis, is available, but you've got to have actually done the thing or committed to doing the thing for the purposes of renting out the property. Now, capital expenditure can't be deducted. Now, capital expenditure is anything that you are going to use within the property rental business over an extended period of time, and which increases the value of the asset. So an example would be an extension. If you are simply replacing something that was already there, albeit in a way that brings it up to modern standards, like taking out single glazed wooden windows and putting in double glazed UPVC windows, that is not capital. That is actually a repair, and that can be set against your property income. So what can be set against your property income? Well, general maintenance and repairs to the property can be. Water rates, council rates, gas and electric, direct insurances such as landlord insurance or buildings insurance, cleaning costs, gardening costs, letting agent fees, property management fees, legal costs for letting the property of less than 1 year or renewing a lease for less than 50 years, accountants fees, office costs such as stationery, printing, the telephone, advertising costs, phone call costs, rent where the property is part of a sublet. Relief is not available to you if the tenant incurs these and tries to recharge them. You must be paying these directly. Now, a common question often relates to the use of your vehicle. Where you use your vehicle for the purposes of administering the rental business and rental properties, a deduction at a fixed rate of 45p a mile for the first 10,000 miles and 25 pence thereafter is the best way of claiming the use of petrol and your car in a tax efficient way. This is actually called the fixed profit mileage scheme. Now, a more complicated thing is the interest and finance costs of the mortgage. Once upon a time, all of the interest that you paid on a buy-to-let mortgage could be set against the mortgage that you had taken out. What this meant was, if your rent was £100 and your interest was £90, your income was only £10. The capital part of the mortgage, if you're taking a capital and repayment part, has never been able to be set against the rent. So if your mortgage was £100 in this on it, but the capital paying element was £50, only £50 of that mortgage would be allowable in the past. From 2021, relief for interest and associated finance costs is given as a tax reducer at basic rate. What this means is it's not fully offsettable anymore. Particularly relevant if you're a 40% taxpayer. Now, a lot of people that we work with are on the borders of being that. We carefully manage taxes to ensure that our clients don't generally cross into 40%. As small business owners, this saves a significant amount of tax to plan things this way. But if you suddenly take on a buy-to-let property, you can readily fall into that 40% bracket, meaning only a proportion, 20%, of the interest that you're paying can be offset against the mortgage. This can significantly increase the value of your rental for tax purposes. And there are loads of examples of this I can show you where people unexpectedly now have substantial tax bills. The most common thing that you will see across the internet to manage this is incorporation. That means becoming a limited company. Great, but comes with its own added complications and is not to be entered into without seeking professional advice. Happily, talk to myself. I will take you through some of the things you are going to have to consider. And if you have existing buy-to-let property, that process of becoming a limited company is particularly complicated. So you may end up with a situation that new properties you buy are owned and held differently to existing properties. The major stumbling block when it actually is calculated for existing properties being converted into a limited company actually relates to stamp duty. I won't cover that in this video as it can get rather techy. The other thing I would urge you to do is keep as many records as you can of what's going on. Ideally, have a separate bank account. Have the mortgage for the property paid from that account, and the rent come into that account, and any expenditure undertaken also pass through that. Keeps things very clean, very simple, and in the event of a tax inquiry, does allow the management and prevention of discovery assessments. So, short guide to what is and is not claimable as a landlord. Thank you very much for listening. I will see you next time.